Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Hello and welcome to Money Over 50. Today we wanted to record an episode called What Does a 30, 40 and 57% drop feel like? This was actually my idea, but pretty much I'll be interviewing you today, Michael, about your experiences throughout your career and particularly during the GFC and the recent volatility. So, mate, first and foremost, can you go through and just give everyone a bit of a recap of your history in the industry and working as a financial planner?
Yeah, of course. Thanks, Dallas. So, look, I started. It's really neat from the point of view that I started in as early as you could start in a new decade. So I started. Well, I guess if you it was the 2nd of January 2001 that I started.
Was it really? Yep,
it was. So, depending on if you count 2000 as the start of the new decade, I suppose you do.
Yep.
But I started on as early as you could in 2001.
Yep.
So I worked for a Townsville, like a big financial planning business in Townsville that will remain unnamed, only to say that it wasn't Storm Financial. So, but so it wasn't Storm Financial, but
it does. Yeah, that's a good point. It doesn't actually matter who it was as long as it wasn't Storm Financial. That's the main point. So
so it was like at the time it wasn't that big, but it grew to be a really big business over the following 10 years.
Yeah,
and that was
you
for
started
me as well. So yeah, look, I mean, I remember thinking, gee, this business has gotten out of hand. It's grown. The personal touch has gone.
Yeah.
You have to grow to a certain level, of course, but I felt it had actually gone too far. So
yeah.
So when you started,
what was your role in
2001? So I started in research and so I started assisting. There was 2 other financial advisors at this firm. I started assisting them by doing research, doing calculations for clients. I started actually looking at writing the financial plans then to get to know all the different scenarios.
So it wasn't necessarily
that type of
client-facing stuff, but it was working on clients' financial plans. So you sort of saw the background of their situation, but not necessarily meeting with clients at that point.
No meeting with clients at that point. So
when did you start meeting with people?
So look, at the time I'd just finished a degree at JCU in business.
Yeah.
With a major in finance. So went into the industry at that point in time. Did more study at that point in time, industry study, and then I started meeting clients at the start of 2003. And at that point in time, I only did for a full year of 2003. I really only did the insurance side of things. For a client meeting. So I'd come in as part of the financial plan. I'd look at those people's insurances and work out what they needed and build that into the financial plan and things like that. So it wasn't until about 2004 that I started actually meeting with people from a financial planning point of view.
Yep. From how's their super invested, that kind of thing. What we would be doing now, kind of thing.
That's right.
So up to that point, I guess, in those early 2000s. So, and we've spoken this before, but what was the mood like of so that was just after the .com bubble had burst, wasn't it?
It was, yeah. So when I started, there had been a downturn in markets around the world. Australia actually and there's a high correlation now between if the American markets fall and the Australian markets fall at the same time.
Yeah.
Back at that stage, the Australian markets really didn't fall too much. It was largely an American markets thing because all of the .com companies were headquartered in America. So
so in those early years, things weren't really
a lot.
Yeah, but we were a bit insulated. So would you be able? I guess would you say that we weren't really booming, but we weren't really feeling much pain at that point? Was it sort of a bit of a neutral phase of the cycle?
Yeah, certainly. Not much pain. The next few years were average years, I would say, average years, even though in the first year that I worked in the industry in September of 2001, September 11, 2001, of course, was an event that changed the world, I guess.
Yeah.
In whichever way you look at it, in the terrorist attacks.
And that was an interesting one shouldn't really say it was interesting because it was a pretty horrific thing to happen, but from a share price point of view, it was really a quick drop, wasn't it? And then a quick rebound that September 11th.
Yeah, look, it dropped really, really quickly. We've spoken about this before. So share markets are really, really quick to move. So I remember the day that the terrorist attacks had happened. I can't remember the exact amount, but the world share markets basically went into free fall.
Yeah,
I hate that term, but they dropped quite a bit that first day, and then proceeded to push down.
Yeah,
and
it's a bit
sat
like
around the 15% down mark for a period of time, and then America decided to invade Iraq. Yeah. And they pushed down further from that as well. And certainly, look, again from memory, it was only America had only been in Iraq for under a month before markets started to turn around and head north again. Yeah. And that's another thing that we've spoken about. Long before the worst news is over, what you'll find is that markets start to recover. Now, what kept them down? What had kept them down at that point in time? The talk in the media was that this was going to be the start of World War III.
Yeah.
And I remember America invading Iraq in 2001, late in the year, early 2002. And within a very, very short period of time, it became apparent that it wasn't going to be World War III. And as soon as that became apparent, in fact, just before it became apparent, what we saw was markets skyrocket back up north.
Yeah.
And that's how fast they move. So
and that's we spoke about this
of World War III, and when it became apparent that it wasn't going to happen, and that the situation at the time they thought it was going to be controlled pretty quickly. Yeah, you saw them recover really, really quickly in that.
And this is what we spoke about just the other day with markets hate uncertainty. Is I guess if you're selling an asset, if the people buying don't have certainty of what the future looks like, you basically are going to be trading at a discount for that uncertainty. And that's kind of what I think what I'm guessing was happening there, is that if you really needed to sell, you had to sell. And people who are buying going, well, I don't know how this situation is going to play out. It's probably going to be fine, but we're going to trade at a 15-20% discount just to sort of make sure. And then that's kind of what we've spoken about, is that by the time the average person is feeling safe and comfortable, and it feels like everything is going to go back to normal, prices have already built that back in, and that discount has gone away, and things are trading back to where they were previously.
Yeah, look, they move so quickly. Markets move so quickly, and like we've commented on this before, but it's worth mentioning again. The current crisis that we're facing with COVID-19, and the threat of a recession, and probably eventual recession. That will occur. We'll be in the middle of that recession, and markets will have jumped. And it'll be too late for people because
Yeah.
At the start of a recession, if a recession is going to go for 2 years, then that's generally the lowest point in the market at the start.
Yeah.
In the middle of the recession, you're already a year in, and you only have a year to go. So the outlook is actually better, and markets creep up, and then all of a sudden they go, and people miss that. People miss that if they're sitting their money in cash, they've actually missed that opportunity.
Yeah, and so I guess that ties into the next phase of your sort of career. There was that in those sort of mid years of 2000. So you started meeting with clients in sort of 2004. Started having sort of your own clients 2004, and then those were sort of the boom years in Australia, weren't they? Those next year.
Yeah. So you're not remembering exact percentages, but 2004, 2005, 2006, 2007. Markets around the world, and when we say markets, this is I guess our industry term, abbreviated term for the largest companies in Australia, the largest companies in America, the largest companies in Europe. So markets around the world in those years did close to twice their average each and every year. So there was years there where they went up by 20%, and then the next year it went up by 23%, and the next year it went up by 20%. So they were really, really high growth years, and profits of companies absolutely soared in those periods of time as well. Yeah. Now, anecdotally looking back, and this wasn't available necessarily at the time, but you looked back, and people, believe it or not, in Australia and America and Europe was spending something like about 103%, 105% of their income. For a good few years there. So 2005, 2006, 2007. Now you say, how's that possible? Actually, how is that possible? What people were doing is there was it coincided with a period of time where house prices especially in Western countries around the world rose sharply during those years, and that created equity for people, and I guess anecdotally later on when people went back and had a look at that, it was easy conditions for lending money as well. So people were borrowing back of their houses and doing renovations, borrowing back of their houses, going on holidays.
There's pretty much only two things really that you can, if you go and borrow $50,000 against your house, you either go and buy $50,000 worth of shares in companies or another house or something like that. So you either invest that money, which drives asset prices up because there's another buyer coming in and picking that price up, or you go and buy a new boat, or you do renovations, or you do something which flows through so that some company is making a profit off that, which drives the company's profits, which also brings price up. So that's, I guess, what we've spoken about before is that this sort of boom bust cycle, it's a completely normal, it's a normal thing. It's something that happens all the time. And that's I guess the concrete example to me of how that happens is that credit's easy. People are spending money. Because people are spending money, profits are soaring of companies, and also their assets are rising in value. There's more, and that becomes a cycle then of it's easy to borrow money to then invest. That drives prices up. Because that's driving prices up, there's more money to come out and spend money. That brings companies' profits up. It becomes a quick feedback loop, I think.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.